Thanks for joining us at xam.com for this Forex Preview. We'll be having a look at non-farm payrolls out of the United States on Friday. I'm Cristina Marujos. Joining me today is Cristina Barcenido, investment analyst. Cristina, U.S. non-farm payrolls have been flourishing since the start of the year. Are we expecting any changes in this pattern in April, and what would that mean for the U.S. economy?
Well, not really. The US is currently living, let's say, the status of a world leader over the COVID crisis. The vaccination rollouts are successfully moving forward in the US. Infections are falling according to the stats, and that allows the government to further reopen its economy and let consumers and businesses to benefit from the super accommodative fiscal and monetary stimulus. So overall, we expect the US labor market to have further improved in April, likely opening 978,000 new jobs positions, which, if true, that would be slightly above the 916,000 number added in March, and that increase in employment is consequently expected to pressure the unemployment rate lower to 5.8% from 6%. Of course, the unemployment rate has still some way to go to reach pre-pandemic levels and, more importantly, reflect full employment conditions which the Fed aims to achieve, but still, this is another encouraging step towards pre-pandemic normal levels, let's say, and that creates more euphoria around the US economy and also provides some confidence and direction to investors who are not very certain about where to push their funds, especially when they compare the US with other key economies such as the Eurozone, where the spread of the virus differs from country to country, or the UK, where political troubles continue to affect sentiment. So what the thriving data mean for this economy now? I would simply say more confidence to the economy and therefore more flows of investment to the US.
Now, looking at forecasts, average hourly earnings are expected to suffer a large slump in April year on year. Should we consider it as a negative development?
Indeed, wage growth is forecast to drop from 4.2% to minus 0.4% year on year, and under pre-pandemic circumstances, that wouldn't be a very good sign for workers. But things are different now, and we shouldn't forget that the figures show the change in average hourly earnings from April 2020 to April 2021. So last year, a large percentage of low-paid workers, especially in the tourism industry, stopped to work because of the pandemic, and that left a larger share of high-paid workers in the market, consequently pushing the wage growth measure higher. This time, the reopening phase has allowed businesses to resume activities and rehire the low-paid workers. So obviously, the return of those workers was probably big enough to push the wage growth in negative area in April. But overall, that's a matter of composition effect in the labor market. There shouldn't be a negative warning for this economy or any indication for the economy. So probably the wage data are not showing the actual picture.
And finally, turning to FX markets, how could the non-farm payrolls report affect the US dollar?
Probably the dollar will not pay great attention to the data once again. Everyone knows how well the US is performing in terms of vaccinations and how supportive policies are from government and the central bank. So better economic releases are widely expected, and an upbeat jobs report wouldn't be something new for investors. Instead, what really matters for the dollar, I think, is what the Fed's next policy step would be. If the inflation fear factor will finally push the Fed to cut some stimulus, as the Bank of Canada did by cutting the pace of its bond purchases, or if the Fed finally admits that rate hikes will come earlier than expected. So far, the Fed has been quite resilient, saying that interest rates will remain stable at record lows through 2023. But on Tuesday, the US Treasury Secretary Janet Yellen surprised markets by saying that a moderate increase in interest rates may be needed to keep the economy from overheating. Well, of course, she rephrased her comments later on, saying that this is not a recommendation or a prediction, and perhaps she's right because the Fed is independent and the final decision will only be taken by the Fed's policymaking board. So her words haven't signaled any changes in monetary policy, but definitely they have increased speculation that monetary tightening is in discussion, and the pressure on the Fed could become even larger as other central banks start to trim their bond purchases, even if the Fed doesn't want to admit it. So to answer the question, I think the dollar may not react on the data on Friday, but from a technical perspective, the risk remains on the upside for dollar yen, and a break above 109.70, I think, could trigger the next rally in the market.
Cristina, thank you for joining me today, and thank you for watching this Forex Preview here at xm.com.